Okay, right. So, sorry, I'm just trying to get rid of this thing here. Right, okay. This is the second part of chapter 9, and this is on doubtful debts. And I have to be careful how I explain this, because more importantly, as well as you understand it, you need to know how to deal with it in a set of accounts. And I remember I explained this during my lecture using two characters in the class at the time. I think it was Olga and I think it was James. It doesn't matter, but I know definitely Olga was involved. So I gave the classic example that you have a scenario where a lady called Olga goes into a restaurant and with her friends and is wearing very high-heeled shoes. Now this restaurant belongs to James, and there's water on the floor. Right, there's water on the floor, and that's this restaurant. I don't know what I'm doing. It's a restaurant. These are chairs. And she goes into the and she slips and falls, right? And there she goes. She falls and breaks her neck. And well, that looks like her neck's cut off entirely. Key point is that she's fallen, broken her neck, and as a result of falling and breaking her neck, imagine this happens in October, and James pays December. And there was water on the floor, and it is James's fault. And James consults his lawyer, who says to him that yes, Olga is a famous celebrity, and people like this, when they fall and they break their necks, they sue. And cases tell us that you will have to probably pay her $20,000. Now, the concept of prudence says to us that, well, you recognize losses straight away. When I say a loss, an event that will bring you some kind of I was going to say shame, an event that will bring you, if you like, a loss or an outflow of expense in any capacity, you recognize it straight away. So what we have here is that we now have an expense. This is due to Olga falling. We know that we will be paying at least reputable, probably, strong probability that you're paying out that amount of money. So what should he do? He should recognize this loss on if you like, just, it's a loss of some sort due to court case. You could put court case, it doesn't matter. 20,000. Now the question here is this. This is E, isn't it? E goes up, and then there's a liability, and liability. So there's a liability he owes. We know that so we create a provision. We call it a provision of some sort. A provision for court case, 20,000. He knows that he now has a liability, a current liability, because typically, remember now that he hasn't paid her any money. It will go to court. The judge will probably see it in November. We don't know when we're going to hear, but at least it's happened. So we don't say, oh, we'll wait until we hear the result. So this gets transferred to the income statement, blah, blah, blah. Remember, our retained earnings, our earnings have now been hit with 20,000, right? Now, we get into the next year, and we're in January, February, and we call the lawyer up and we say, how are things going in court? And he says, oh, actually, things are actually worse. The judge actually thinks you'll actually have to pay her 25,000. Well, we don't come back. You're like, well, fair enough, no problem. In that new year, we don't come back and put 25,000 through again, do we? We just put the extra 5, right? Through our loss, we just put additional loss because we've already put through 20. So additional loss, if you like, on court case. And we just add that additional loss to that provision. So now we know, if you like, that so you can see we had 20 kind of come down, brought down from the previous period. We now add in the extra 5. So now the carry down, of course, is 25. So we're still waiting. This gets transferred to the income statement. So this is just to show you that in reality, right, the income statement is just a continuity of this business from its very beginning, many years ago. And if you never take out profit, everything just heaps. Everything just heaps on each other, just heaps. So we're just separating with periods, right? Right, so we now owe 25. Now, hey, if the judge comes along and says, okay, please pay her money, what do you simply do? You have bank, 25,000 leaves your account, and you debit the liability account, and this account closes, right, because the money's now left the bank. And that's the process of what's going on here. Now let's now move on to discuss this question of a provision for doubtful debts. Now again, like I said, what we have here is that based on experience, trade receivables might be 50,000. Based on experience, what you're saying, you see, when you say this, you say 50,000, you say that, oh, I believe that I will receive 50,000. This is the 31st of December. You're saying that I will receive 50,000 from my clients in the coming period. Now, based on experience, we always notice that when we look in the new year, when we looked at last year, we noticed that maybe you only got back, overall, you got back 40,000. Just in general, you know, overall you actually lose, if you like, 20% of your, a fifth of your trade receivables last year. When we look in the new year, right? Because this is December, so we're really hoping this money comes in January, February. And we look in January, February, and only 40,000 comes in. And we look at the year before, and maybe the year before you had 40,000 at the year end, and we noticed that in January, February as well, maybe only 30,000 came in. So we start to see a pattern, and we're like, well, actually, this is misleading, you see, because really, in truth, what's really happening is, yes, you may have sold all these, but that's not what really comes in. So we create this, we have this idea. Remember that prudence tells us to anticipate all potential loss. So there is a potential loss here. And fair enough, we don't know. It's not a bad debt, but it is a doubtful debt. It's doubtful that you will get 10,000. We can already see that. And because we want to protect users of financial statements, we have to recognize this 10,000 that you're we almost anticipate and guess it. If it doesn't happen, no problem. We can reverse it. Kind of like the court case. We can always, yes, we can play with it. So the key point here is that we always have a percentage. So you say something like, oh, 5% doubtful debt. So for example, if you have £10,000, right? So if we said that 0.05 times 10,000. So if we said that, oh, let me just make that more, 10%, doubtful debts. So what are we saying? We think that you're going to lose, we think, probability that you'll lose £1,000. So what we simply do is, well, no problem. We have the doubtful debt. We have £1,000. It's an expense, no problem. And then we have, if you like, this provision for doubtful debts. How do we recognize this provision for doubtful debts? In the balance sheet, you will have your trade receivable of £10,000 here, and we will have the £1,000 underneath, and we have 9,000. So we're just letting everyone know that we think you might lose 1,000 of these, so we really think the trade receivable will be 9,000. That's what we think. It's not a problem. You see, the key point here being that we've already, now once I transfer this to the income statement, I have already made this initial expense. So from now on, when I move into the future, remember, I just think in the future. So think of this as a court case that just never ends. So in the future, I now say in the following year, I now say, oh, you now have maybe, I don't know, trade receivables 50,000. And I say, well, listen, again, you seem to lose a bit every year. So I think in the future that you will lose another, I don't know, say 5% of this. You're going to lose 5% of that times 50,000. If I think you're going to lose 2,500 in the future, remember, you've not paid out this money. You have this provision coming down every single year. It's carried down, carried down. The same way with that court case, right? Well, if I think you're going to lose 2,500, well, I've already put the 1,000 from the previous year. So all I do is I just put another 1,500. I have 1,500. And so my carry down figure becomes 2,500, right? So this one tends to be a little tricky when I say tricky for students to sort of see, but always go back to this idea of what happened to Olga when she fell. Just think, I've already put through a bit. I'm only just topping up, and you could reverse, for example. So it could be the opposite, right? So in this scenario, if for example, I'm just going to do a quick reversal before I end this video. It's getting long. So for example, if for the first year you had put 1,000 through, this gets transferred to the income statement. No, it's done. Good. The next year you have 1,000 coming down, of course, and then you actually think it's going to be 500. Well, your income statement is not going to read you debiting the expense, but in a way it's a source of income. So you have, let me just use a different pen color, you now have 500 coming in, and you have that 500 reducing that profit made from the previous years, bringing the carry down figure to be 500, and then we now have 500 over here. So we think now this is, if you like, a source of income. In exactly the same way with the court case. If the judge now says, actually, I think you're only going to have to pay out 15, well, you just kind of reverse that provision, reduce that provision, that liability, and thereby increasing your income in your income statement. Okay, great. Whoa, that's 10 minutes. That's long. Great. And so I'm going to do the last bit of this in another video, but of this chapter. But please, if you like, read that chapter. Hopefully this helps as a booster, and when we're doing exam key questions, that will confirm your knowledge, but at least you know you have a starting point to work with. Okay, great stuff. Thank you. See you in the next final video on chapter 9.